Every 2 weeks, you get your paycheck. And before it even hits your account, a chunk is already gone. Taxes taken automatically. No choice, no negotiation. Meanwhile, someone worth $10 billion just increased their net worth by $2 billion this year. Guess how much tax they paid on that $2 billion? Wait for it. 0. Stay with me, because what I'm about to show you will completely change how you think about money, taxes, and why the system feels so unfair. And no, this has nothing to do with illegal activity. This is about rules you were never taught. Here's what they don't teach you in school. The tax system isn't designed around income, it's designed around behavior. And the wealthy, they behave completely differently than you do. Let me prove it. Most people earn money one way: salary. You trade your time for a paycheck. Your employer pays you. The government taxes it immediately. Simple, predictable, automatic. But here's the thing. Wealthy individuals don't rely on salary. In fact, many billionaires take salaries of exactly $1 per year. Jeff Bezos, $1. Larry Ellison, $1. Mark Zuckerberg, $1. So if they're not earning income like you, how are they buying yachts, private islands, and $50 million mansions? That question, that gap, is where everything changes, because there's a concept the wealthy understand that most people never learn, and once you see it, you can't unsee it. Here's the first massive unlock. There's a difference between income and wealth. Income is money you earn. Wealth is assets you own. And here's the critical part most people miss. Taxes are triggered when income is realized, not when wealth grows. Let me break this down with a real example. Let's say you own stock in a company. This year, that stock goes up in value by $100 million. Question: did you just earn $100 million? According to your bank account, no. According to your net worth, yes. But here's the key. You didn't sell the stock. And if you don't sell, you don't pay capital gains tax. This is called unrealized gains, and it's one of the biggest structural differences between how employees are taxed versus how the wealthy are taxed. Your paycheck, realized immediately, taxed immediately. Their wealth, unrealized, untaxed. Now, you might be thinking, okay, but eventually they have to sell, right? Wrong. Because here's where the strategy gets absolutely genius. Wealthy people don't sell their assets to fund their lifestyle. They borrow against them. Let me walk you through exactly how this works. Imagine you own $5 billion in stock. You want to buy a $200 million mansion. Here's what you don't do. Sell $200 million in stock, pay capital gains tax, let's say 20%, lose $40 million to taxes, buy the house with what's left. Here's what you do instead. Go to a private bank. Use your stock as collateral. Take out a $200 million loan, pay maybe 2 to 3% interest annually. Now here's the magic. Loans are not taxable income, so you just accessed $200 million in cash without selling anything, without triggering a single tax event. And because you're ultra wealthy, the bank gives you an interest rate of maybe 2%. That's $4 million per year in interest. Compare that to the $40 million you would have paid in taxes. You just saved $36 million. But wait, doesn't this create a problem? Don't you eventually have to pay back the loan? Here's where it gets even more strategic. Your stock keeps growing in value, let's say 8% per year. So you're paying 2% interest while your collateral grows at 8%. You're making money while borrowing money. And when you need more cash, you borrow more against the increased value. This cycle can continue indefinitely. It's called buy, borrow, die. Buy appreciating assets, borrow against them tax-free, die and pass them to heirs with favorable tax treatment. Take a breath, because I know what you're feeling right now. This sounds unfair, broken, maybe even wrong. But here's what you need to understand. This isn't illegal. It's not a glitch. This is built into the system. And that realization should make you ask a different question entirely. The tax code rewards asset ownership more than it rewards labor, and that's not an accident. Tax systems are designed to encourage certain behaviors: investment, business creation, capital allocation, economic growth. Governments want people investing in companies, building businesses, and creating jobs, so they create tax incentives around those activities. But here's the side effect nobody talks about. If you're living primarily from labor income, you're taxed heavily. If you're living primarily from capital growth, you have massive flexibility. Let me show you the numbers. Ordinary income tax, your salary. In many places, this can be 30 to 40% or higher for top earners. Long-term capital gains tax, selling assets you've held over a year, often 15 to 20%. Same amount of money, completely different tax rate. But it gets deeper, because the wealthy aren't just paying lower rates, they're playing in a completely different tax category. And this is where most people's understanding breaks down. If you're an employee, your tax options are extremely limited. Your employer withholds taxes automatically. You get a W-2 at the end of the year. You have almost no deductible expenses. Maybe you can deduct some home office space if you're lucky. But if you own a business, everything changes. Businesses can deduct legitimate operating expenses, office space, travel if it's business-related, meals with clients, equipment and technology, marketing and advertising, staff salaries, professional development, research costs. These deductions reduce your taxable profit. Now here's where lifestyle and business start to strategically overlap. That business trip to Miami? Tax deductible. That Tesla you use for business purposes? Depreciable. That home office? Deductible. Let me be clear, I'm not saying people should commit fraud. These need to be legitimate business expenses. But the point is this, when you operate through business structures, you have tools that employees simply don't have. And wealthy individuals don't just own one business, they own networks of entities, LLCs, S-corps, trusts, holding companies, investment partnerships. Each structure serves a purpose, each creates flexibility, each provides strategic advantages. Now I want you to imagine something for a second. Imagine you earn $100,000 this year as an employee. How much of that do you actually keep after taxes? Maybe $65,000 to $70,000? Now imagine you earn $100,000 through a business structure with strategic deductions. Suddenly you might keep $80,000 to $85,000. Same income, different structure, vastly different outcome. That difference compounds every single year, and that's just scratching the surface. Here's something nobody talks about. The wealthy aren't just having more money, they have more expertise. Think about it. When tax season comes, what do? Maybe you use TurboTax. Maybe you hire an accountant for a few $100s. You file, you're done. When tax season comes for a billionaire, here's what happens. They convene a team. Tax attorneys, CPAs specializing in international tax law, financial strategists, estate planners, investment advisors. This team doesn't just file taxes, they engineer the entire financial structure to minimize tax liability legally. They ask questions like, should we realize gains this year or defer? Can we offset gains with strategic losses? Should we invest through this entity or that one? What jurisdiction offers the best treatment? How do we structure this to optimize for 3 generations from now? A top-tier tax attorney might cost $1,500 per hour. Sounds expensive, right? But if that attorney saves you $50 million in taxes, that $1,500 per hour becomes the best investment you've ever made. The wealthy don't see professional fees as expenses, they see them as leverage. And this creates a compounding knowledge gap. The more wealth you have, the more expertise you can afford. The more expertise you have, the more wealth you preserve. The more wealth you preserve, the more expertise you can afford. It's a flywheel. Now, let's zoom out, because this isn't just about individual strategies. This is about how the entire system is designed. Governments create tax incentives intentionally. Let me give you some examples. Depreciation allows businesses to deduct the cost of assets over time. A real estate investor can claim depreciation on a building even while that building is increasing in value. Think about that. The asset is becoming more valuable, but the tax code lets you claim it's losing value. R&D credits. Companies that invest in research and development get tax credits. This encourages innovation. Opportunity zones.
Invest in designated areas, get tax benefits. This encourages capital flow into underserved communities. Retirement accounts, 401ks, IRAs, these defer or eliminate taxes on investment growth. These aren't loopholes, they're designed features of the tax code. The system is trying to incentivize specific economic behaviors, build businesses, invest in communities, save for retirement, innovate. But here's the uncomfortable truth. These incentives disproportionately benefit people who already have capital. So instead of asking, why don't the rich pay taxes, ask this instead. Why is labor taxed differently than capital? What does that tell us about what the system values? This isn't about villains and victims, it's about incentives. The tax system incentivizes ownership, leverage, and capital allocation. It taxes simplicity and labor. And most people live in simplicity and labor. I know this might feel frustrating. Maybe